Welcome back to another video, guys. My name is the Main Street Investor, and we are here to check out McKesson Corporation, ticker symbol MCK, which is a healthcare distributor with a market cap of approximately $71.87 billion. Now, before we go any further, I want to give a quick shout out to Lamax2980. Thank you so much for the stock idea. Remember, if you have any stocks that you would like to see analyzed, please just leave a comment down below and I'll try to make a video for it. So with that, let's get right into it. So as we usually do, we're going to take a quick look at their most recent earnings call presentation, and we're going to see what exactly is McKesson and how are they performing recently. So first and foremost, this is a healthcare distributor with the purpose of advancing health outcomes for all. They aim for integrity, inclusion, customer first, accountability, blah, 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 blah. They're basically just bringing medications and different medical devices to their different customers, which obviously ends up in the hands of professionals looking to take care of regular people. Now, I do find it quite cute that at the very bottom here, they made sure to include their 12 to 14% long-term adjusted EPS growth target, which is great. That's a really solid target. Just not sure why they needed to put that on their About Us page. So for some of the news in the most recent quarter, McKesson had revenues of $93.7 billion, which increased 21%, which is pretty solid, although their diluted earnings per share was quite a bit lower than what it was recently. But, we do some accounting tricks, and instead now it's at $7.07, which is up 13% year over year. The company continued to advance its oncology platform, which deals with a lot of cancers, and that's a big focus for many companies now and into the future as much of America and the Western world starts to age. Another big move was the announcement to sell their Canadian-based Rexall and Well.ca retail businesses. That should help boost their margins and get the company out of underperforming businesses. And the last major thing was that McKesson launched InspiroGene, which is a business focusing on supporting the commercialization of cell and gene therapies, which many people see as the kind of next frontier of personalized medicine, which could obviously mean huge growth in the future if it's successful. So the big news that I highlighted earlier that McKesson really felt the need for everyone to see was that they're raising their 2025 adjusted EPS outlook to $32.40 to $33 per share. That's a bit higher than where it originally was, as we'll see in a little bit. But that would represent growth of 13 to 15% compared to the prior year, which is excellent earning per share growth, and an indicated range of 18 to 20% growth in adjusted diluted earnings per share. The company is also raising its buyback repurchase target from $2.8 billion to approximately $3.2 billion for 2025, which does make a big difference. I mean, $400 million is nothing to scoff at, and the $3.2 billion overall is really incredible buybacks, and we will see that later on. So in the fiscal 2025 outlook, we can see that McKesson has raised its diluted earnings per share outlook based on the previous 31.75 to 32.55 to 32.40 and 33. They are expecting 15 to 17% growth versus 13 to 15% growth originally expected, and 13 to 15% operating profit growth versus 10 to 15%. So a slight boost in the bottom end of that range. Corporate expenses are expected to go up, which isn't amazing, but you take the good with the bad. And the same can be said about interest expenses, although their interest expenses are falling a little bit from their previous estimations, even though they are up based on the 2024 year. McKesson's effective tax rate is going to be 17 to 19%, which is about the same as 2024, a little bit higher potentially. So we could see a slight adverse effect from taxation, but not a big deal at the end of the day. The big news is that the free cash flow is expected to be $4.8 to $5.2 billion for the next fiscal year versus $3.6 billion for 2024. So a nice big jump. And of course, with more cash, you can do more things like pay more dividends, or in this case, more buybacks. So that's going to be excellent news for McKesson shareholders. That should put a really nice floor on the stock's price. And then last thing to look at really closely here is the 2025 adjusted outlook for their specific segments. So in their US pharmaceuticals, they're expected to grow 16 to 19%, which is about a 3% boost in both the bottom and top line expectations. Prescription technology has gone down quite a bit though, from 14 to 18% expected growth to only 8 to 12. We also see a lower medical and surgical solutions growth, 3 to 7% drop down to 1 to 5% growth. And their international segment looks largely flat, 5 to 9% growth versus 4 to 8%. So a slight raise, but nothing major. Most of their operating profit segments are expected to grow about the same as they expected previously, with no change in the prescriptions or medical surgical solutions, but a slight bump in US pharmaceutical and actually a really good bump in the international segments, likely in part due to the spinoff of their Canadian retail businesses. So now that we know a little bit about McKesson as a company, let's take a look at some recent headlines. Starting with a recent earnings, this is back from August, but the healthcare giant McKesson dives amid big revenue miss. And I think this article brings up something important, a little bit lower, so let's check that out. And I think the big thing to underline here is that McKesson cited a number of factors for weakness in their revenues, including a quote shift from brand to biosimilar, as well as significantly less demand for COVID test kits and other related products. Now, it's not that McKesson is going to be completely destroyed by the shift to biosimilars or less demand for COVID products. I'm sure they're planning for, especially the COVID products, to start going down in revenue. But to me, the biggest worry is that the shift to biosimilar is occurring at such a rapid pace, just like the pharmaceutical companies that develop these products. As a distributor, McKesson really likes to see the name brands, like in this case, Humira is listed. They like to see Humira grow its revenues, grow its sales, and when the exclusivity for products like Humira run out, that allows any company to start making the drug at a much lower price, which means there's more distributors for cheaper drugs, and that basically means competition. So it's a perfectly normal part of capitalism and the type of business that McKesson runs, but it is something to keep an eye on. Biosimilars will continue to come out, and any sort of shift in policy on biosimilars and intellectual rights for new drugs could mean serious shakeups in McKesson's business. And I'm not going to spend too much time on this, but the big news here is that McKesson recently announced it's going to close a medical distribution center amid industry challenges. This will occur in the spring of 2025, and nearly 200 employees will be laid off. So I think this just goes to highlight that the issues are not done for McKesson, and the company is still working to keep up with a challenging industry by lowering its overall cost structure. And finally, just wanted to give a brief update here. This is as of January 2nd, so when I'm recording this, that is yesterday. And McKesson stock declines, that's not a big deal, but they have completed their divestiture of their Canadian brand businesses. McKesson did sell their Canadian-based Rexall and Well.ca businesses to Birch Hill Equity Partners, a private equity company. And like many divestitures for companies, this was done in order to prioritize investments, and in McKesson's case, to expand their strategic oncology and biopharma growth platforms. Essentially, they're trying to get rid of a lower growing, thinner margin business in order to focus on higher margin, faster growing segments of their company. Makes total sense. Now, before we move into looking at the company's balance sheet, its income statement, and a bunch of different valuations, I would just like to say thank you so much for stopping by in this video and for checking it out. I really appreciate it. If you could do me one more big favor and leave a like down below, comment on the video, and if you like the video, subscribe to my channel. It would really mean a lot to me. Thank you so much, and let's get into those numbers. So what stands out to me initially is that the total revenues and operating income both saw really nice growth at about 9% year over year for the last 5 years, but that was also equally paced by a slightly higher growth in cost of goods sold and a gross profit that's basically flat. So McKesson is growing its business, although its margins are struggling to expand and its costs are continuing to go up. The company's net interest expense is super manageable at just under $200 million per year, so really nothing to worry about there as far as debt is concerned. But I do want to point out that its earnings from continuing operations, its net income, diluted earnings per share are quite volatile. Even if we exclude 2020, it does grow quite rapidly and then fall off quite rapidly as well. So that's something to be aware of. This company is not a perfectly steady grower, at least on its bottom line. As we can see in the revenue per share, that is super consistent at about 18.6% per year for the last 5 years. And that massive growth is largely due to the buybacks that we can see here on the right. The company buys back nearly 8% of its outstanding shares per year over the last 5 years. And that really has a huge effect on the earnings per share metrics and continues to let you own a larger and larger portion of the business over time. And then taking a look at EBITDA growth and EBIT growth, both are a little bit more steady than the earnings per share at about 6% for EBITDA and 7% per year for EBIT. And the company pays a really nice growing dividend, grows at about 12% per year for the last 5 years, which is really incredible, although it does go through spurts like 2019 to 2020, where there's very little growth, and then other years where it has very large growth between 2021, 2022, and into 2023. What should be noted is that the company's dividend payout ratio is super low, currently sitting at 12.89%, so there's plenty of room for this company to raise its dividend. McKesson has no problem making its sales. Its change in inventories continue to grow very quickly. And the company's capital expenditures, though growing, is quite manageable, growing at about 9.5% per year and only sitting at about $520 million for the most recent year. Net debt issued has gotten quite flat recently. We can see that McKesson generally pays back a lot of debt, but recently did issue $703 million in debt, and in the most recent year paid back net on net $20 million in debt. So the company does manage its debt quite well, I will give it that. And they do have growing free cash flow at about 5.72% per year for the last 5 years. So nothing here looks extremely worrisome. Taking a look at McKesson's balance sheet, their cash and short-term investments position has gotten quite small recently, but it does still sit at about $2.5 billion, which would cover a lot for the company, so I'm not terribly worried about that. The company's total receivables and inventories have been growing nicely. Assets have been growing a little bit slower. Long-term debt has been pretty much flat, but I do want to point out that long-term liabilities have been growing at about 8.32% per year. So if we take a look at total assets growing at 4% per year versus total liabilities at 8% per year, that's a little bit worrisome. And we can see that their total liabilities currently sit at $75 billion versus total assets of only $72.5 billion. So that leads to a total stockholder equity that is actually negative. Now, what total stockholder equity is you take your assets, you subtract your liabilities, and that number should generally, hopefully, be positive, meaning you have more on your books than what you owe. But that is not the case for McKesson. They actually do have more liabilities than they have assets, so it's something to keep an eye out on. Not necessarily a bad thing, but I wouldn't call it a good thing either. We can see that book value per share and tangible book value per share are consistently negative, and the company's net debt, though it has been going down at 3.2% per year for the last 5 years, has taken a really large spike from $2.8 billion in 2023 to $4.7 billion in 2024. So something to keep an eye on. How is this company managing its debt in the next few years? Gross margins have consistently been coming down from 5% in 2019 to 4% in 2024. Operating margins have been basically flat, starting at 1.34% and ending at 1.31%, and their free cash flow margins typically fluctuate between 1% and 1.5%. Now, it is important to note that this company, McKesson, is a distributor. Distributors do not have very large margins. This isn't a problem with McKesson in particular. All distributors have razor thin margins. That's just how their business operates. So they have huge revenues and not very high, gross profits and bottom line type numbers. The company's return on assets does fluctuate quite a bit, mostly I would say due to COVID, to be honest, but it is sitting at 3.5%, which is better than where it started in 2019, but well below its peak in 2022 of 5.7%. Now, due to their stockholder equity being negative, their return on stockholders' equity is also negative, currently sitting at negative 95.99, so not a very useful number here. McKesson's current ratio continues to slowly deteriorate from about 1 in 2019 to 0.91 in 2024, so not a large or fast deterioration, but something to keep an eye on over time, as you should hope that the company can pay off its liabilities with its assets if it ever needed to. We see the same trend in the quick ratio, dropping from 0.6 to 0.5. Again, not ultra worrisome, but it is a slow deterioration over time. But what certainly looks a lot better for McKesson is that their long-term debt to EBITDA has fallen from 1.6 in 2019 to 1.1 in 2024, so the company earns more on a leverage basis than it did 5 years ago. Same with its long-term debt to EBIT, where it was 1.73. It is now 1.17. Way manageable. So I'm not particularly worried about the debt load and the fact that the company has more liabilities than they have assets, because they have plenty of earnings before interest and tax to cover those liabilities. Down below, we can see their current EBITDA interest coverage is 27 times. Their EBIT coverage is 25 times, and their free cash flow interest coverage is 24.5 times. So even though the company does pay a significant amount of interest, it is extremely well covered currently. And I don't see any major scenarios where McKesson has any problems in the near future covering their interest, because even if we look at 2020, their free cash flow is able to cover their expenses by 15 times. So this company does manage to structure its debt very, very well. And just one more reminder, did you forget to like the video? Don't forget to like the video. So taking a look at McKesson's price to sales ratio, we can see it's currently trading at 0.23 versus its long-term average of 0.14. Now, technically, this does create a premium to the average of 59%, although I do want to point out that for the first maybe 2 to 3 years, McKesson was trading at a ridiculously cheap valuation. So I do think a lot of these numbers are quite depressed as far as their 5-year average is concerned. So we will see a lot of premiums show up that are probably a bit misleading, and I think we should look at the absolute numbers more than the premium or discount to average. McKesson trades at a 29 times earnings currently, which is quite high even compared to its long-term average. But as we can see, expected earnings would lead to a valuation of $571 by 2025 versus its current price of $576. So we can say that McKesson is basically pricing in its fiscal year plus one earnings at its current price. If we look out to 2026, we can see that the stock's valuation should be $640 by the end of 2026 and $723 by the end of 2027. So there is plenty of growth in this stock and its share price if analyst expectations are correct. McKesson's trading at a current price to EBITDA of 15.5, which is pretty fair in general, so I won't consider this to be 78% overvalued as the chart would suggest. Its price to EBIT 16.31, again a pretty fair number. And McKesson trades at 17 times its free cash flow, which once again quite fair, although it looks like there's a huge premium to its long-term average. Again, for the first 2 to 3 years, this company traded at a ridiculous valuation, so that is skewing the long-term average data. Now, price to book value and price to tangible book value are basically useless for us because both numbers are negative. But if we take a look at McKesson's dividend yield, again, the long-term average is quite skewed due to the fact that the company was very undervalued in 2019, 2020, and 2021. But with that said, its long-term average is 0.85%, and the company trades at a current yield of 0.45%. So that is a little bit less than I personally look for, but great dividend growth ahead. So if you're more about dividend growth versus current dividend yield, McKesson is potentially a very attractive choice. The company's enterprise value to EBITDA currently sits at 27 times, which is actually a little bit high in my opinion. The long-term average of 18.42 does seem much more reasonable for a company like this. So on this metric, I do believe that the premium to average of 46.5% is probably somewhat accurate. I also think that the enterprise value to free cash flow number is probably also fairly accurate, currently trading at 30 times versus its long-term average of 21 times, which would lead to a premium of 43%. Taking a look at McKesson's drawdown chart, this is the massive drawdown I was talking about. So all of our 5-year numbers start right around here, right at the very bottom of its long drawdown to 55%. So that is why I say that a lot of these numbers are quite skewed by the beginning couple of years. Since 2018 and 2019, though, McKesson has recovered really nicely, currently sits at a 8.5% drawdown today. And if we take a look at the drawdown numbers, we should take a quick note to see that this company does regularly draw down more than 20%. I mean, it happened twice in 2014. Even during this large drawdown, we see large spikes down in 2016 from 18% drawdown to a 37% drawdown, then right back up 20%, and then down 30%, and then up 20, down 20, up 20, down 15. So this company can be quite volatile. That is something to be aware of. It is a solid company based on the numbers, but its stock price does react quite sporadically to news. And finally, taking a look at our X factors, we can see that there's a 13.77% compound annual growth rate expected for McKesson over the next 5 years. So if we take and remember to the numbers that the company gave in its most recent earnings presentation, this is on the lower end of that, but many analysts do believe that the company can achieve a 13 to 14% growth, which is certainly quite solid. This leads to a PEGI ratio, or a price to earnings over growth plus yield, of 2.1 times and an FG ratio of 1.23 times. And what the FG ratio is, it's the enterprise value divided by the company's free cash flow divided by the sum of its growth plus yield. So if you aren't familiar with my videos, essentially what the PEGI and the FG ratio are looking at is the current company's valuation and dividing it by its growth, the 13.77%, and its dividend yield if it has one, which is about 0.5% currently, which in its most simple terms is taking the company's current valuation and dividing it by its long-term expected total return. So just taking a quick recap of the things I like and do not like about this company. Starting out, I really like the business model for the coming decades. McKesson is obviously going to benefit from the aging populations in the Western world. They're also positioning themselves nicely by going into oncology and gene therapy. So I think the company does know where the growth segments are, and they are positioning themselves to be a part of that, which is really good strategic planning in my mind. The company also has a really awesome stock buyback program. I mean, there's no other way to put it. They spend a lot of money buying back their shares, and that does help you as a shareholder. The longer you hold the shares, the more stock that's bought back, the more you benefit. And then third, they do have a very low dividend payout ratio. So this isn't really a stock that you necessarily buy specifically for the dividend, but in the long term, there is plenty of growth available because the company's payout ratio is so low. Management can raise the dividend payouts quite significantly, even if the company kind of stagnates for a few years. Now, what I do not like is general uncertainty surrounding the Department of Health. Now, this kind of goes back to current news today about Robert Kennedy Jr. being the head of Department of Health. There's a lot of worry that he's going to really disrupt the industry. And that brings me to my second point. The low margin business is vulnerable to disruption. Now, maybe not necessarily disruption from a competitor business, but disruption from a legislative standpoint is more what I'm thinking is a near-term risk. Now, does that mean I know that something is going to happen or not happen? No, not at all. But I think the general unpredictability of the incoming Department of Health under the new Trump administration does lead to a little bit more uncertainty for all healthcare stocks, and especially those with very thin margins like distributors, aka McKesson. And finally, I am not a fan of the negative stockholder equity trend. The company's liabilities are growing faster than their assets, and they currently have more liabilities than they have assets. Now, like I said, a lot of their liabilities have very low interest rates and are very easily covered by the money that the company earns, but it's still a troubling trend, at least in my opinion. So, what are my final thoughts on McKesson? It's a really excellent company. Management does seem to have a pretty decent grasp on the industry, and they are performing quite nicely. For me personally, I think the company is probably around fair value now, and I don't see a lot of margin of safety like there was in 2017, 18, and 19. So I'm not personally looking to invest in this company today, although if it did have a larger margin of safety, I would be very interested in it. Of course, that's not meant to discourage you. If you really like McKesson, by all means, invest your money how you want to. I wish the best of luck on all of your investments. And with that, I hope you guys enjoyed the video. One last reminder, please like the video and subscribe to my channel as it really means a ton to me. And if you want to see any stock analyzed, please leave a comment down below. Thank you again so much for making it to the end, and I hope you guys have a great day. Bye.